This is part 2 of the discussion on financial ratio classification. I'm done with the liquidity ratios already, and now I will start discussing solvency ratios. To recap, solvency ratios deal with the ratios which tell the user about the capability of companies to settle long-term obligations. Now let's start. What I will do is set the accounting equation here. Asset equals liability plus equity. And then divide all elements by assets. Divided by A, divided by A, and divided by A. Of course, the left side is 1. Asset over asset is 1. Liability over asset, this is called debt ratio. While equity over asset is called equity ratio. This is formula 1 and this is formula 2 for solvency ratio. And I believe the two ratios here are very self-explanatory. Debt ratio tells the percentage of the contribution of outside parties in the total resources of the company, while equity ratio tells the portion of the owners in the total resources of a company. And then we have another ratio, and it's called debt to equity ratio. And the good thing about this one is that you already have the formula in the name. The formula is liability over equity. And this ratio basically tells you the discrepancy between your liability and equity. And with this kind of ratio, if the answer is more than 1, it simply means that the company is a risk taker for getting more liabilities than equity. And on the other hand, if this is lower than 1, it means that the company may be conservative in their acquisition of resources. That's what our debt to equity ratio is telling. And then we have another, it's called times interest earned. This is part of the solvency ratio, but for the formula, I will give it later. Now, let's jump to another classification under financial ratio, and this one is called profitability ratios. You want to know more about the capability of a company to earn? You refer to these ratios. Before I give you the formula, let me first set up the equation that we are doing whenever we are preparing the income statement of merchandising business. I will start with net sales, deduct your cost of sales to get your gross profit, plus other income to get your total income, minus your operating expenses to get your operating profit or your EBIT, and then deduct your interest to get your EBT, earnings before tax, minus tax to get your net profit. This is also called earnings after tax. And what you will do is get gross profit and divide it by net sales. Same with your operating profit and net profit. This will give you gross profit margin, this is operating profit margin, and this is net profit margin. By just looking at the formula alone, this is just the proportion of the following profits and your net sales. And then get your net profit again, divide it by your average total asset as well as your average total equity. The first one will give you the return on assets. And this one is called return on equity. And same with the previous one, this tells you the peso profit that you get for every peso of assets, and that's for return on assets, or equity for return on equity. And then to add, get your net sales, divide this one by your average total asset, and you will get total asset turnover. And same with the previous one, this is the amount of sales that you get for every asset invested in the company. So in total, for profitability, we have 1, 2, 3, 4, 5, 6. And earlier I mentioned times interest earned. What's the formula of that? Get your EBIT and then divide it with the account under it. Divide this by your interest expense. Will give you times interest earned. And this is very self-explanatory. What it tells you is the number of times you can pay off your interest using your operating profit. Again, times interest earned is part of the solvency ratios. And that's it for the financial ratios. I may upload another video on financial ratio with me answering an exercise. Anyway, just stay tuned and see you in the next.